Critical Man Pictures presents the Forex Video Training Series. Black Belt, Second Degree, Trade Guide to the Major Economies, Australia. Officially known as the Commonwealth of Australia, Australia can be found somewhere in the Southern Hemisphere, just southeast of Asia. Considered as the world's biggest island, Australia is the only country on Earth that governs an entire continent. Before the coming of settlers from Europe in 1788, Aboriginal people inhabited most of the country. Since then, people from all over the world have migrated to Australia, which has made it one of the most culturally diverse countries in the world. Now, Australia is home to people from more than 200 different countries. Lastly, and probably most important, Australia is known for producing the meanest and most hardcore actors in the world. To add to that, they also have kangaroos, battle tank armadillos, and bomber pelicans. You can see how the rest of the world really has no choice to name an entire continent after them. All joking aside, just a couple of extra fun facts if you so choose. And the economic overview. Compared to the G7 nations, Australia's overall economy is relatively small. According to the World Bank, however, on a per-person basis, its GDP is even higher than the UK, Germany, and even the US. In the past 15 years or so, Australia's economy has grown an average of 3.6% annually, well above the 2.5% world norm. No wonder it is ranked first in the Legatum Institute's 2008 Prosperity Index. Australia's economy is highly service-oriented, with almost 69% of its GDP coming from industries such as finance, education, and tourism. Despite having a very robust export industry and stellar growth, Australia has been notoriously famous for consistently having a high current account deficit. This means Australia is using up more resources from other countries to satisfy its own domestic consumption. The Reserve Bank of Australia, RBA, is the main governing body of Australia when it comes to monetary and fiscal policy. The RBA's aim is threefold: keep exchange rates stable, ensure growth, maintain full employment. In order to do this, the bank believes that the country's annual inflation rate must be kept within 2 to 3%. By keeping a tight rein on inflation, the value of the domestic currency is secured, which will eventually lead to sustainable economic growth. How does the RBA make sure inflation is controlled? Two ways. One, adjusting the cash rate, and two, conducting open market operations. The cash rate is the interest rate charged by lending banks on overnight loans to other financial institutions. Open market operations, on the other hand, is the way RBA controls money supply through the buying and selling of government loans or other financial assets. With the exception of January, the RBA meets monthly to discuss what changes it will make to the monetary policy. To make this easier to swallow, take this example. Let's say the inflation from Australia is increasing much faster than the bank wants. In order to suppress the high inflation rate, the bank decides to raise the cash rate, which will effectively increase the cost of borrowing by borrowers. Naturally, this will tone down lending, lessening the overall money in circulation, and basic supply and demand tells us that the scarcer something is, the more valuable it is. Even though they got the mixed seasons, the Australians are always bright and early to play. Well, this is mostly because the Australian market is the first to open every week. Just like people inhabiting the place, Australia's local currency, the odd, is called the Aussie. One important characteristic of the Aussie is a high positive correlation with gold prices. The reason behind this is Australia is the third largest gold digger, or gold producer, in the world, with the shiny metal making up more than 55% of their total exports. This translates to 12 billion Australian dollars per year. As a result, whenever the price of gold rises or falls, the Australian dollar goes along for the ride. Among the major currencies, the Aussie has been known for having a high interest rate. This makes it a favorite for carry trade. Carry trade is a practice of buying a currency with a high interest rate in exchange for a currency with a low interest rate. Most of the Australian dollar's movement happened during the Asian trading session, a time when economic data from Australia is released. Unless there's some major news during the European or US trading sessions, the Aussie dollar usually trades in tight ranges. Given the commodity-based economy of Australia, unfavorable weather conditions tend to put a serious strain on Australia's growth, which leads to a sell-off in the Aussie. Let's just say that during the Australian drought of 2002, Aussie dollar US dollar fell to 0.4770. That's almost half of its current exchange rate. Some of the important economic indicators are the Consumer Price Index. Because of the RBA's primary goal in controlling inflation, the CPI, which measures the overall change in price of consumer goods and services, is closely watched by the bank. The balance of trade. Australia has an extremely robust trade sector, so currency traders and bank officials alike tend to watch changes in the country's export and import levels. The gross domestic product. This measures how well Australia's economy is doing. Positive readings indicate economic growth, while negative readings mean economic contraction. The employment rate. The unemployment rate tracks how many people in Australia's labor force are out of work. The number of people employed, or rather unemployed in this case, has a high correlation with economic activity. A person without a job has less money available for spending. What moves the Australian dollar? The Aussie is greatly affected by macroeconomic factors such as monetary policy rhetoric, interest rates, and domestic economic data. In trading the Aussie, always pay special attention to the interest rate outlook. Comments made by officials from the RBA regarding interest rates, for example, could create a hefty impact on the Aussie. For the better part of the last decade, China had been on a roll, posting some massive growth figures. In order to create finished goods, China sources a lot of its raw materials like coal and iron ore from Australia. For China to buy raw materials from Australia, it must first need to exchange its local currency for the Aussie. This means increased in demand for Chinese goods tend to prop up the Australian dollar's value. Likewise, a decline in demand for Chinese product could lead to a fall in the Aussie's value. To a lesser extent, data from New Zealand influences the Aussie's price action. To take note that New Zealand's economy is very similar to Australia's, which makes their currency relatively correlated. In fact, the relationship between the two countries is sometimes described as trans-Tasman to show how closely tied their economies are and to indicate the existence of the Tasman Sea sitting right between them. With that said, it is important to be aware of upcoming data from New Zealand, as it could indirectly cause the Aussie dollar to move. Some trading tactics. Since the Aussie is one of the best candidates for a carry trade, which is the buying of currency with a high interest rate and the selling of a currency with a low interest rate, Aussie dollar, US dollar is highly affected by crosses. How can you use this to your advantage? Well, if you see a break of a significant technical support level in the Aussie yen, this could be a good sign to sell Aussie US dollar. Another thing to consider when trading the Aussie dollar, US dollar, is data coming out from New Zealand. Because Australia's nearest trade relations with New Zealand, positive economic data from New Zealand usually helps push the Aussie value up. This means that better than expected New Zealand economic reports could be seen as a good signal to buy the Aussie. Conversely, poor economic data from New Zealand could be a good reason to sell the Aussie. Lastly, take some time to look how commodity prices, especially gold, are doing. More often than not, the price of gold leads the Aussie dollar. This means that whenever the gold rises in value, the Aussie US dollar soon could rally. Of course, when the value of gold falls, the Aussie tends to follow suit.